Hi guys, good afternoon and welcome to Money Control. I'm Karunya Rao and in conversation with me today is Vandana from Vanda Insights. She's joining us all the way from Singapore. Vandana, thank you so much for taking time out on a very important day when the energy markets definitely are the talk of the town, very much in the limelight. Ahead of that OPEC meeting, we've seen oil prices also climb more than $1 per barrel. Talk to us about the backdrop that we are in and what could be actually the top of the agenda today, because the street seems to be divided on whether there will be status quo or whether there will be a cut in production.
Good afternoon, Karunya. So indeed, it's going to be a bit of a difficult decision for OPEC Plus. We do know from the Saudi energy minister's comments a couple of weeks ago that Brent around, let's say, $90 per barrel levels seems to be a pain threshold for Saudi Arabia and, most likely for a lot of the other OPEC Plus members as well. So the expectation in the market now is that that's the level they will try and defend. And today, as we speak, Brent is trading around $95 a barrel. So not quite at the pain threshold for OPEC Plus, but still, every now and then it has threatened to crash towards that level. Now, while OPEC Plus can contemplate a production cut, the reason I say it's not an easy decision for them is, first of all, OPEC Plus is already pumping close to 2.9 million barrels per day below their target. So, there's a huge deficit already. So how do you cut in that environment? On paper, the cut will need to be more than 2.9 million barrels per day to translate into an effective supply cut. I think also OPEC Plus wants to be careful not to be seen to be uber hawkish at a time when inflation is a major problem around the world. And, we are all sort of sliding towards a recessionary environment. And, they have faced a lot of pressure from oil consuming countries to keep the prices down. I think they will keep that in mind as well. I personally expect a rollover, or maybe they'll withdraw the 100,000 barrels per day token increase that they had made for September. I can't hear you, Karunya.
Okay, sorry, I think I was on mute. I was saying that if indeed there will be no cut this time around, it looks unlikely. How will the oil markets react to that?
So I think that is baked in into current prices. You're seeing almost a 2% jump in crude prices this morning in Asia. It is being propped up quite a bit by the worsening energy crisis in Europe. Now, while the Europe crisis is more to do with gas and of course, spiraling into the electricity markets, there is an expectation and already some of replacement of gas by oil, mainly diesel. So Europe's crisis is a prop for gas prices, for oil prices. And we also have the G7 now on Friday deciding to press ahead with the Russia oil export price cap plan. That could create a bit of a disturbance. Usually uncertainty of that kind is bullish in oil markets.
Okay, all right. Also wanted to get in your view on the oil leakage at Portuvaya compressor station, which has made it unlikely that gas flows from NS1 resume. So how big a dent or how big an impact could that have?
It's more a psychological impact. So we have to keep in mind that Russia has been reducing its gas supply to Europe. And, Europe had nearly 40% import dependency on Russia for its gas imports in last year. And Russia has been, it's Russia's way of basically retaliating against all the sanctions that the EU and the US has been placing against it. If we look at the Nord Stream 1, which is the pipeline from Russia to Germany, quite a major pipeline, almost, a little over a third of total EU gas imports come from this pipeline. But in terms of what happened over the weekend, Russia is saying that it's uncertain when it will resume gas imports. You have to keep in mind that the pipeline was already delivering just about 20% of its capacity. So in that sense, it's not such a big shock. Europe has been gradually getting around this problem of lower gas supplies from Russia. It has been turning to coal. It has been trying to reduce its consumption, and of course, buying more LNG, importing more LNG as well. But having said that, I think the bigger fear now is that what happens if Putin continues to further reduce gas supply to Europe, especially going into the crucial winter demand season.
Okay, all right. While gas prices have continued to be very very robust, oil prices in the past 3 consecutive months have fallen a fair bit. We saw that the phenomenal rise they saw, especially in the month of March. From there has been quite a bit of retreating for the oil prices.
Yes.
So, for both of these commodities, whether it's natural gas or oil, what is the forecast for the rest of the year? Will oil continue to be range bound and gas continue to outperform? Is that going to be the big trend?
Yeah, that's a very interesting perspective, Karunya. So if you look at oil and gas, I expect them to remain on divergent paths. As you quite rightly point out, oil has been softening. Two main reasons for that. One was Russian crude supply into the global markets did not get hit as badly as had been feared in the initial months after the Ukraine invasion. So Russia has managed to divert quite a bit of the crude which is being rejected by Europe into countries like China and India, to some extent Turkey as well. When it comes to refined products, again, the country has managed to place the barrels into countries in Africa, Latin America. So Russian supply, while yes, it's less than what the volumes were before the Ukraine invasion and sanctions, it's not been cut off to the extent that had been feared. The second reason is that the market is bracing for quite a bit of drop in global oil demand. And this is all anticipatory, of course. As of now, demand is still continuing to grow. Year-on-year levels globally, it is going up. But the expectation is that this could plateau. So those are two main reasons. Gas is on a completely different trajectory. I think Europe is short of gas. It's been struggling to fill up its storages in readiness for winter. LNG prices have been, hitting almost new record highs after the March spike that we saw. So continued divergent paths, I would think, for the two commodities.
Okay. As far as this OPEC meeting is concerned, where is Russia in all of this? Because I was reading, a report or two wherein it's likely that Russia will not support any kind of a cut, in oil supply.
Yeah, so that has been the report over the weekend. I'm not very surprised, because as of now, if Russia was really hampered in supplying its oil to the market, so as of now, maybe 1 million barrels per day of Russian supply has been affected. At one point of time, the fear was that up to 3 million barrels of Russian supply into the markets could disappear as a result of sanctions. So maybe that would have been good enough reason for Russia to support a cut, because it wouldn't want its peer countries in the OPEC to take over its market share. So as of now, they probably think there is no reason to cut back, which I think is a valid view. I think prices are still well supported. As I said, $95 is not that bad a price for most of the OPEC plus countries, including Russia.
Okay. Just one more thing before we let you go. Back home in India, windfall tax on crude oil was increased very recently from 13,000 per ton to 13,500 per ton, and export duty was also increased on ATF, on diesel as well. So, given the way oil prices are behaving, on top of that, these revised taxes and duties, what is your forecast, or what is your insight on how fuel prices could sort of shape up for Indian consumers?
So, first of all, the windfall tax in the upstream industry, it has been reduced quite a bit. When it was introduced, it was about $40 a barrel. The latest, it's about $24 a barrel, which seems to have been done in tandem with the reduction in crude prices. But I think there is a major concern here for me that the upstream industry in the country, it actually needs all the support it can get to continue building India's crude production prowess. and that's not happening right now. And what the oil companies need is predictability, certainty, and transparency as well. There should be an exit clause when the government introduces ad hoc taxes. Uh, Companies should have certain amount of visibility into what will be the process to remove those taxes. I think it's quite worrying personally that that's not happening either on the upstream windfall tax front or on the product export taxes. Look, as far as product export taxes are concerned, if there was really a shortage in the country in terms of fuel supplies, and which I don't think there is, it would have made sense for the government to try and curb exports. But refining margins have come off dramatically from the highs that we saw in May and June. So they really, I mean, it is quite a pain point for refiners as well to be paying these taxes, and then the unpredictability of it. When they're planning their refinery runs, their crude imports, their product exports, they don't know what the tax will be that they'll have to pay. So, companies work best when they have a stable and predictable regulatory environment and fiscal environment, which is what they're not getting at the moment.
Okay, all right, Vandana. Thank you so much for chatting with us and sharing your insights with us on the oil markets. Of course, the big question will be what is it that OPEC Plus will finally decide, whether they will cut the output or not, and we'll find out by tomorrow when we're back with a fresh update on commodities. But for today, this is it from us. Thank you so much for tuning in.